Hey everyone, welcome back to the channel. Today we are diving into one of the most powerful yet underrated investing strategies, dividend investing. If you're looking for a smart way to generate passive income and grow your wealth without constantly buying and selling stocks, this video is tailor-made for you. Whether you are a beginner curious about how dividends work or an investor wanting to refine your approach, stick around. We are breaking down what dividend investing really is, why it works, how to get started, and the risks you should watch out for. Let's jump right in. So, what exactly is dividend investing? In simple terms, it means investing in shares of companies that regularly distribute a portion of their profits to shareholders in the form of dividends. These payouts usually happen quarterly or annually, and they land directly in your bank account. Think of it as a reward for staying invested in a business. In India, companies like ITC, Coal India, Power Grid Corporation, and Hindustan Zinc are known for their consistent and high dividend payouts. These are often well-established businesses with stable earnings, making them attractive to investors who want regular cash flow without having to sell their shares. Now, why should you care about dividends? For starters, dividend investing creates passive income. Money that flows in without requiring you to do anything after your initial investment. It's a popular strategy for people looking to supplement their salary, save for retirement, or achieve financial freedom. Secondly, dividend-paying companies are usually financially sound and less volatile during market downturns. Third, you benefit from the power of compounding if you choose to reinvest your dividends. Let's say you invest 1 lakh in a stock offering a 4% dividend yield. If you reinvest that 4,000 rupees every year, your investment could grow significantly over time, especially if the company also increases its dividend year after year. Lastly, dividends can act as a partial hedge against inflation. If a company hikes its dividend in line with its earnings, your income grows even as the cost of living rises. So, how do you begin your dividend investing journey in India? Start by identifying companies with a strong dividend paying history. Look for a track record of consistent, or better yet, increasing dividends over the past 5 to 10 years. ITC, Bajaj Auto, and HCL Technologies are solid examples. The next thing to check is dividend yield, which is calculated as the annual dividend divided by the stock price. For example, a 10 rupee dividend on a 200 rupee stock gives you a 5% yield. But be careful. High yields can sometimes be a red flag if the company isn't growing or has weak financials. That's why it's important to also look at the payout ratio, which tells you how much of the company's profit is being given away as dividends. Ideally, you want companies that have a payout ratio of 30 to 60%, enough to reward shareholders, but still reinvest in growth. One way to get exposure without stock picking is through a dividend-focused ETF or mutual fund. For example, the Nippon India ETF Nifty Dividend Opportunities 50 gives you access to 50 top dividend-paying companies in one basket. It's great for beginners and those who want passive exposure to this strategy. Similarly, mutual funds like ICICI Prudential Dividend Yield Equity Fund or UTI Dividend Yield Fund are actively managed and aim to capture both yield and potential growth. When it comes to dividend investing strategies, you can go with a high yield approach where you focus on companies offering 6 to 8% dividends like Vedanta or Coal India. Or you might prefer a dividend growth approach targeting companies like Infosys or Asian Paints that steadily increase payouts year after year. A balanced strategy mixing both is often ideal for most retail investors. A quick but important note on taxation. In India, dividends are now taxed as per your income tax slab. Additionally, if your annual dividend income from a company exceeds 5,000 rupees, a 10% TDS, tax deducted at source, applies. So while dividends are a great income source, Don't forget to account for taxes when calculating your net returns. For high income earners, dividend income could be taxed at 30%, which reduces the effective yield. Of course, dividend investing isn't risk-free. Companies can reduce or suspend dividends during tough times. A classic example is what we saw during the 2020 pandemic, when several banks and cyclical businesses either paused or slashed their payouts. Also, during bullish growth cycles, dividend stocks might underperform high growth tech stocks. Plus, rising interest rates make bonds and FDs more attractive, which can pull investors away from dividend stocks and impact their price. So while dividend investing is powerful, it should be just one part of a well-diversified portfolio. To sum up, dividend investing is a solid strategy if you're looking for stability, regular income, and the potential for long-term wealth creation. It's not flashy, but it's reliable, especially when combined with patience and consistency. Just remember to diversify across sectors, keep an eye on payout ratios, and periodically review your holdings.